My name is Howard Tang. I'm the CEO of Peritus Capital. And because of the intimacy, I think we're going to have a lot of time for Q&A. But let me go through my prepared remarks first, and then we'll kind of get into those a little bit later. First and foremost, thanks for everyone attending today. For this third day in Barcelona, we're going to keep it very fun, light, and relevant. Our topic today is the impact of ESG and sustainability on aquaculture investment. Now, this can be a very wide-ranging topic, and we could spend hours talking about green finance, but I don't want to try to boil the ocean today. In the next half hour or so, we're going to look at some of the leaders in aquaculture and really understand how their policies have evolved over time. Through this very targeted scope, there's a lot that we can learn and understand. We'll then try to define who the winners of this ESG and sustainability investment trend are and some of the challenges that are arising from this very massive trend. And then for the remainder of the hour, I hope to take some questions from the audience. So I hope you have some interesting ones or hard ones for me. I'm happy to tackle them all. So let's jump right in. So let me just share first a little bit about who we are as the Peritus Capital. So Peritus is an ESG and sustainability-focused investment firm. We work with businesses that are integrating environmental social governance into their day-to-day practices. We do seed-oriented investments, but we also capital raise from institutional firms like pension funds as well as family offices. Most of our time is spent in the seafood arena, particularly the aquaculture space. But we also dabble in alternative proteins as well as in the renewable energy sector. I've completed about $100 million worth of financing specifically in aquaculture, and I've worked with some notable globally integrated players as well as supported some greenfield projects in the aquaculture space. So worldwide, growth of sustainable investment has really been extraordinary, as you can see from the chart. Every region has seen significant growth in the investment class. As we can see from these figures from the Global Sustainable Investment Alliance. In the past 6 years, assets under management for the US have compounded by 17%. In Canada, they've grown by 21%. Australasia, somewhere in the range of 36%. And in Japan, sustainable investment grew by a very staggering 168%. One figure on the table, though, should stand out. Europe's poor showing at 1% annualized growth over the last 6 years. Yeah, a little shocking, isn't it? But its tepid pace, however, is actually very misleading. Regulators have been forcing the asset management industry in Europe to properly define what a sustainable investment product is. Which only validates the focus on sustainability in Europe, but it does take some of the wind out of the growth numbers that we see in that particular region, until at least the industry adapts to the new regulations and the changes. Now, let's talk about how this incredible trend has now translated over to aquaculture. So on the screen, you're going to see the Kohler Fair Index. It's actually one of the most comprehensive ESG benchmarks available. It actually compares the performance of 60 of the largest public meat, dairy, fish producers across 10 ESG themes and 33 key performance indicators. They examine a range of issues at these producers, ranging from greenhouse gas emissions, the use of antibiotics, waste and pollution created from the value chain, and it's read by asset managers that represent $45 trillion worth of assets. The Kohler Fair Index is a very, very influential report in the ESG space. And at the top of the list, as you can see here, are aquaculture companies. Maui, previously known as Marine Harvest, is actually in the #1 spot. They harvest 466,000 tons per year, if you don't know Maui that well. And it's one of the largest Atlantic salmon farmers with 20% of the global market share. It has a vertically integrated approach from egg to plate and actually produces its own feed. Grieg Seafood is actually number 2 on the index. It's also a vertically integrated salmon farmer, and last year harvested over 89,000 metric tons of salmon. And Leroy Seafood came in at number 4. It's more diversified than Maui and Grieg, and they harvest over 142,000 salmon and over 28,000 tons of trout. Leroy also does some wild catch in the whitefish and the shellfish and the pelagic space. But what's really interesting, and I really hope the environmentalists kind of pay attention here, is that aquaculture companies rank at the highest levels among protein producers. This is worldwide for sustainability. Now let's take a closer look at these 3 aquaculture leaders to really see where they're spending time from an ESG and sustainability perspective. And through their eyes, we can learn a bit more about how sustainability is influencing the entire sector. The environment is the key sustainability concern for the protein industry. Terrestrial proteins such as beef, chicken, and pork are major contributors to greenhouse gas emissions. And as the population balloons to 10 billion plus by 2050, things are only going to become a little bit more difficult. Aquaculture has a smaller carbon footprint than these other protein sources, but practiced poorly can be very pollutive, obviously, to the oceans and the environment. So what you're seeing here is the key sustainability goals for Maui, Grieg, and Leroy, as discussed in their annual reports and sustainability filings. And we're going to explore these a little bit. On the production side, for instance, there's a huge reliance on certifications to validate the sustainability of their harvests. Grieg and Leroy, for instance, are pledging to have their farm sites blessed by the Aquaculture Stewardship Council. By 2023, in fact, Grieg wants to have all of their farm sites ASC certified. Maui wants 100% of its harvest certified by a global sustainability standard, but it doesn't need to be ASC. Greenhouse gas emissions are also on the agenda, and all 3 companies are pledging to reduce their total emissions across scope 1, 2, and 3 types of assets. Now, scope classifications can be a little confusing, so I'm going to define this a little bit. Scope 1 covers direct emissions from owned or controlled sources. For a vertically integrated fish farm, that would be, of course, the fish and your production and processing equipment. Scope 2 covers indirect emissions from the generation of purchased electricity, steam, heating, and cooling. And Scope 3, which actually includes indirect emissions that occur in the company's value chain, for instance, purchased goods. And the tricky one's going to be Scope 3. Even regulators have a hard time tracking Scope 3 emissions. Scope 3 can often be the most significant part of a company's carbon footprint, and you have no control over them besides your buying decisions. So as regulations tighten here, I expect this to drive some really big changes at producers. Investment support, for instance, will throw its weight behind more local food production, where the transport footprint is going to be smaller. Take, for example, a retailer that has to choose between a domestic or land farm fish closer to its locations over one that has to be imported from overseas. These are the types of opportunities that are evolving from Scope 3 policies and definitely favor local production methods like recirculating aquaculture systems and land-based fish farming. Human ingestion of microplastics is also a super scary issue, especially for me. There are studies that estimate that people ingest 0.1 to 5 grams of microplastics per week, with most of that coming from drinking water. So these aquaculture leaders have been doing their part in finding ways to reduce plastic across their value chain. They have extensive recycling programs and are working towards eliminating non-recyclable plastics from overall use. And all 3 of these companies are targeting zero fish escapes from their net pens and cages, because there's a constant fear that these escapees could reproduce with the wild population or spread disease. It's also a very visible problem that can rile up consumers, fishermen, and indigenous groups in areas that they operate. Sea lice gets a lot of attention, both as an operational and a sustainability issue. All 3 companies are utilizing a mix of preventative, biological, medicinal and non-medicinal methods to really address the sea lice problem. Now, thanks to documentaries such as Seaspiracy, fish welfare has become a huge concern for consumers. But aquaculture leaders have already been conscious of fish welfare because it does impact the quality of the fish and the prices that you can get. Companies, for instance, are already using humane stunning methods for killing. They've reduced stocking density in terms of their grow-out pens, so the fish have more room to swim. And they try to minimize the handling during the production process so there's less stress on the actual fish. We've also seen a fair bit of innovation in this space, ranging from improved stunners to AI and machine learning monitoring systems. So consumer attention probably accelerated the adoption, but by no means was it wholly ignored even before. Now, at all three of these companies, they have a mission to eliminate antibiotic use at the farm as well, or at least minimize it to worst case situations if there's an outbreak of ISA or some other type of fish disease. On the feed side, a key sustainability issue is in their value chain. Deforestation of the Brazilian rainforest for soy, which is a key ingredient in aqua feed, and the killing of forage fish for fish meal and oil has really been the top of the agenda here. All three have really pledged to support the development of novel feed ingredients, such as insect meal, algae, and more sustainable marine ingredients to replace these sources. But the Kohler Affair report actually points out that fish meal alternatives lack a tremendous amount of scale, and aquaculture companies could do a bit better job investing in this particular area of the market. So entrepreneurs should definitely take note. I think there's VC and corporate investment here will accelerate the growth of this novel feed space in the coming years. On the social side, in ESG, it definitely gets a lot less attention from aquaculture businesses, but that's not specific just to seafood. We'll take a quick peek at social and governance topics, and then we'll return to the environmental ones. On the social side, community engagement is really important for these aquaculture businesses, since their farm sites are often located among rural communities far away from population centers. Local regulators can fight or delay your expansion plans, and if you're seen as an outsider to the community, you're just trying to extract value. And that's a core concern and a reason why social elements are focused on in the sustainability plans of these businesses. There's also a focus on food safety and quality, not only as an ESG goal, but really a requirement for consumer trust. Goals in this area often have to do with targeting no food recalls for safety and producing fish that can be classed as superior in quality. The major theme on the S side is really to drive female leadership and to narrow the gender gap at a lot of these companies. I'll give you, for an instance, Maui is aiming to have 30% of its leadership female by 2025 and an employee gender ratio of about 50-50 by the same year. And now we're going to round out a discussion just on the governance side for these aquaculture businesses. So even before ESG themes became a hot topic, management should have been practicing ethically. I think we can all agree on that. And operational excellence is a natural goal for any organization, aquaculture or not. So thankfully, there isn't a lot to talk about here in terms of governance. Now we're going to talk a little bit about green financing. All three of these companies have used their sustainability credentials to issue green bonds over the last few years. Maui was the first in 2018, followed by Grieg, and last year Leroy issued one. A green bond is a specialized instrument. It not only provides a financial return to investors, but it's focused on accelerating green initiatives of a company. How it works is that the proceeds from the bond can only be used towards projects with an agreed upon positive impact to the environment. A company lays out their use of proceeds in a framing document where they provide an analysis of how that capital will be deployed and what its environmental impact will be. They then create a committee that actually decides which of these projects will receive the proceeds of the bond and how all of this aligns with sustainability. Companies have independent audits on these particular projects to confirm that they were used for the right things. And if it falls out of scope, the capital must go elsewhere. Now, if you think this sounds pretty cumbersome and expensive, you're absolutely right. But we'll talk a little bit about that later. In Maui's green bond framework, for example, it allows for the proceeds of its bond to be used on projects in areas we just touched upon. So this snapshot report, they zero in on sustainable farming, sustainable feed, waste and wastewater reduction, energy efficiency and renewables, and the development of circular economies. In practice, the capital for the bond mainly covered the building of a feed facility in Scotland for 164 million euros. The facility could only use soy sourced from deforestation-free sources. And then Mao spent the remainder of the bond, 35 million euros, for several recirculating aquaculture systems like the one shown here in Fajara, designed for post-smolt production. Now, this facility can actually grow smolt to 350 grams in size and reduces freshwater usage by 98% when in compared to flow-through systems. Looking at Grieg's green bond framework is actually unsurprisingly similar to Maui's, given the parallels between the two businesses. But you have to give it to Grieg for making a very provocative statement in its framework. At the time, the company actually called out feed from Cargill Aqua Nutrition, saying that it wouldn't be using the proceeds from its green bond for any feed purchases until Cargill addressed its soy-related deforestation issues in Brazil. It was a very bold move from the company, since Grieg itself doesn't actually produce any of its own feed. Grieg would ultimately spend the majority of its green bonds on recirc systems or recirculating aquaculture systems for post-smolt across operations in Finnmark, Norway, British Columbia, and Newfoundland, Canada. For Maui and Grieg, post-smolt RAS facilities seem to really yield the best bang for the buck. They drive a lot of ocean sustainability by reducing the time in grow-out net pens, which reduces time in water, vaccine use, feed, and overall mortalities at these businesses. We'll need to wait a little while to see what Leroy will ultimately fund with their new bond, since they issued it late last year. But their framework places a bit more emphasis on traceability, not surprising since they have wild catch operations, and also clean transportation with zero emission vessels, and R&D for novel feed ingredients. As you can see here, the usual suspects related to sustainable aquaculture, renewable energy, water and wastewater management are also in the framework. So now that we've gone through some of the hot topics for these leading aquaculture companies, what I want to do is talk about some of the winners from this huge ESG wave. Now, the obvious one is Mother Earth. Clearly, initiatives and projects that focus on reducing waste and GHG emissions, revitalizing the ocean and keeping them clean will have a very positive effect for the environment. Tying green projects to the access to financing is creating very relevant change, as we saw with the green bonds. I mean, we already saw Grieg's outspokenness on Cargill's soy dilemma and the heavy investments in post-smolt facilities, which have all kinds of sustainability benefits. Another major winner is actually ESG data providers and certifiers. Here's a list of ESG research and certification companies that actually support just one of the big three that we were talking about. Now, the truth is that no company can possibly keep up with the changing regulations and data demands of sustainability. So they need to outsource and rely on third-party certifications to develop their sustainability credentials. Cicero, for instance, provides third-party opinions on green investments, such as the green bonds. Sustainalytics is part of a multi-billion-dollar research behemoth, Morningstar. Their corporate ESG ratings have been embedded into credit facilities where interest rates are actually pegged to them. And this is very similar to Moody's and S&P for traditional credit. And the Aquaculture Stewardship Council and Marine Stewardship Council on the right should be very familiar to this crowd because they validate best practices for aquaculture as well as fishing. It's a huge multi-billion-dollar market that has actually grown out to support the ESG investments and corporate sustainability initiatives. So a definite big winner of this particular trend. Financiers are definite winners here too. Take, for instance, the green bonds that we're just talking about. They've already reached $500 billion in issuance. And ESG products ranging from exchange-traded funds, so ETFs, ESG-linked credit facilities and mutual funds, and derivatives are just absolutely proliferating. There are trillions of dollars at play, and Wall Street is doing quite well selling these new instruments. The stakeholder movement, which has also been ignited by ESG and sustainability. And this is really the evolution of a company's purpose to be more than a vehicle to maximize shareholder wealth and profits. The movement recognizes that a company must balance the needs of a wider group of stakeholders, such as its customers, employees, regulators, and community with its shareholder goals. I borrowed this particular slide from a McKinsey report titled 5 Ways That ESG Creates Value, because it provides some really great examples on the stakeholder movement. Providing customers, for instance, with more sustainable products drives top-line growth through premium prices and attracting new customers, but these sustainable products also deliver a benefit to the community by making environmentally friendly, health and socially conscious choices available. And this is a stakeholder view. McKinsey in their report also talked about how environmentally conscious decisions can reduce waste, fresh water use, and energy costs that benefits both the environment as well as the cost structure. And regulators in this stakeholder view model are seen as potential allies, far from the view that companies should fight any type of regulation. Companies are encouraged really to engage with regulators to help support sensible policies that can improve the business environment. And employees, of course, are another key constituent here. Companies that support ESG policies can really boost employee morale and attract talent who are interested in serving a greater purpose than just a simple paycheck. Of course, with every meaningful trend, there can be growing pains and challenges, especially when trillions of dollars are on the line. ESG investment is certainly not special in this particular regard. While ESG and sustainability investing can be a force for very positive change, investors should be on guard for green or ESG washing. This is when companies attribute sustainability features that can be exaggerations or complete falsehoods to really tap into the capital flow. Some fascinating examples have been uncovered by Bloomberg News, for example. One example that I'll cite is that one of the largest ESG-focused exchange-traded funds, the $22.9 billion iShares ESG Aware, that's a mouthful to say, has almost 3.1% of assets invested in oil and gas, arguably one of the largest contributors to climate change. And when Russia invaded the Ukraine, well-rated ESG funds actually owned $8.3 billion of Russian government and corporate debt. On the seafood side, the US government in March banned imports of Russian fish and seafood products as part of their expanding package of sanctions. But according to the Wall Street Journal, many tons of Russian fish have actually been allowed to slip into the US because complex supply chains that route their way through China often mask the Russian origin of the seafood, and the US lacks tools to trace these origins. These examples, of course, challenge the primary benefit of ESG investing, which is supposed to avoid these landmines for investors. Another challenge worth talking about is the inflationary nature of sustainability-focused products. Often, the investment proposition for developing these products is to be able to sell at a premium compared to non-sustainable alternatives. And even certain trends that support ocean sustainability, such as land-based fish farming through recirculating aquaculture systems, tend to be costlier for consumers because there's extensive CapEx and OpEx needs to cover. Euro area inflation already runs at 7.5%, and the US at nearly 8%. So consumer inflation really can't be ignored, and this may come to challenge sustainability over time. As we were just discussing, seafood origins can also be very suspect. So while a consumer may be happy to pay more for a product, they may be getting something else that could be the antithesis of what those extra dollars were supposed to support in the first place. Now, there are some voices that challenge the notion that ESG improves investment performance. Companies, after all, have higher costs to contend with when driving sustainability through their organizations. Take, for instance, the added costs for third-party certifications or in purchasing goods that have better carbon footprints. It's a lot more expensive. There's a lot of added costs to the cost structure. Recently, I was actually working with a fairly significant global aquaculture player who actually canceled the green bond initiative over the cost of the offering and the time required to prepare the business for all the sustainability requirements. And in a recent Journal of Finance paper, University of Chicago researchers actually analyzed 20,000 mutual funds for their sustainability ratings. And this represented about $8 trillion worth of assets under management. Now, the highest rated ESG funds in terms of sustainability certainly attracted more capital flows than the lowest rated funds. Yet none of the high sustainability funds outperformed any of the lower rated funds. In the Harvard Business Review article discussing these actual results, the author suggested a very interesting reason, that ESG might be redundant. So if you take Russia and Ukraine, for instance, before it became an ESG risk, I actually studied in school about political risks in investing. According to the author, in a competitive labor and product market, corporate managers trying to maximize shareholder value should of their own accord pay attention to employee, customer, community, and environmental interests. So sometimes setting ESG targets may actually distort decision-making at these companies. And this may be a redundant cost for something that they already need to be paying attention to. Now, naturally, I wouldn't give a talk about ESG investment if I believed in these notions. The answer in my mind is actually a little bit more nuanced. It's always an investment by investment consideration. Some companies live their purpose, while others only market it for capital, and it's up to the investors to differentiate between the two. But what ESG has definitely done for investors is raise the bar and the scrutiny for best practices at aquaculture businesses, which is very positive for all stakeholders involved. Coming to a conclusion, sustainability investment has grown into a multi-trillion-dollar focus, and aquaculture has definitely felt the impact. Leaders in the space have very extensive policies and KPIs to demonstrate their sustainability credentials. They've used these credentials to tap the growing green finance market with green bonds. Sustainable feed, greenhouse gas emissions, renewable energy, water and waste management, they're all key concerns that are driving aquaculture agendas. So opportunities exist for innovators and technologists that can deliver solutions to these problems. There are also some very clear winners of this movement: data providers, innovators, employees. But for consumers and shareholders, it's not always clear. Greenwashing dilutes the value of ESG, and some prominent studies indicate poor correlation between high ESG scores and investment returns. Still, ESG policies have become prominent across aquaculture. Corporate managers and entrepreneurs that ignore this particular trend, they put themselves at a very grave disadvantage to peers that actually embrace it. They also risk losing access to a burgeoning and very powerful green finance market. The key will always be to build your ESG policies around your purpose, not the other way around. When your values connect with the values of your customers, capital will find you, no matter what acronym we might use. Thank you, guys. So we have 30 minutes to hang out and take questions, and I'm happy to do that, or just chit-chat. I don't have a big ad lib section, so everybody's going to have to ask questions. Yes, sir, in the glasses. Yeah.
I'm with Regal Springs. Okay, yeah, you can. It's a small group. So I'm with Regal Springs, which is a major premium tilapia producer, vertically integrated.
Sure, I know you guys.
With farms in Indonesia, Ecuador, and Mexico. Something I wanted to maybe pick up your brain and others on is, do you have any metrics or studies on shareholders or let's say corporate valuation resulting from ESG or sustainability performance? When you value a company, and you're probably much more a finance guy than I am, you would see the financials. This is really what we are used to talk about, the P&Ls, really the financial metrics. Now you have all this literature about non-financial metrics, but I'm curious to see how much of an upside or a downside, actually, in some cases, your ESG, let's say, strategy could bring in terms of corporate value.
Sure. So it's a great question. And I think the starting point for Regal Springs and any aquaculture business, actually, is, again, taking a look at some of the publicly traded leaders in the aquaculture space, like we were doing in the presentation. Maui, Grieg, Leroy, there's a handful of others that actually showcase all the things that they're focused on in terms of sustainability. Okay. All right. Is that better for? All right. So I'm not going to repeat all that. Hopefully everybody heard it, but raise your hand if you didn't hear it. I'll repeat it again. Good. All right. We're going to stay with this part. So there's a lot of information readily available by those publicly traded companies, as well as the Collier Fair Report, that gives you an indication of what these organizations are focused on and what perhaps Regal Springs might be interested in being focused on as a tilapia producer. And on the question about returns, I think that there's data that obviously indicates that there is some kind of a separation between higher investment returns versus more traditional products. And I'm glad this is more of an intimate group, because probably my peers would skewer me for this. And we are ESG sustainability focused. But like I was saying in the presentation, it's very investment by investment specific. Some companies are utilizing the trend in order to tap into the capital flow. And obviously we don't think that that's appropriate. It doesn't really add value to your stakeholders. It doesn't add value to your products, et cetera. Some companies are just trying to capture that premium. But those that actually live their purpose, we've found that not only do they have improved returns to shareholders from a public capital markets perspective, but also generate lower overall risk within the business, which is sometimes harder to translate into the stock price or some kind of investment return. So, I think for Regal, certainly start there. Collier Fair Report, also an absolutely great place to take a look. And they've been very, very open in terms of their sustainability policies and their overall focus. Yeah. Yes, sir. Other glasses. Good to meet you.
Likewise. There's a lot of information coming out of Australia now about how we are too over-reliant on wild caught species. We are quite blessed in Australia to only have, in some ways, to only have a country around 35 million people with so much water.
Yeah.
And so we are blessed with wild caught stocks, but we know that that's not the future. A lot of the talk, I mean, if you could put your finance hat on here again, is we're seeing, you sort of said that if you focus on ESG as an aquaculture player, the money will come to you. But we're seeing now that the move is going from wild to aquaculture, and aquaculture is now going to this plant-based aquaculture.
Right.
And we're all concerned as perhaps maybe, I won't speak on behalf of everyone, but
So as a consumer of seafood products and all types of seafood products, I think that the plant-based initiatives that are coming, wild-caught products, certain wild-caught products, aquaculture products, obviously, give a lot of good diversity to the production methods that are happening all across the world. And I think that that kind of diversity is helpful for consumers. It's also helpful for investors and other stakeholders. I'm not a believer that all wild catch should be thrown out the door, because you're impacting indigenous communities. You're impacting employment in rural areas that don't necessarily have better employment opportunities and prospects. And when you eliminate 8 million tons of or 80 million tons of wild catch, it needs to be replaced somehow, and everything else ends up going to a higher price if you don't have a method of replacement. So I believe in some of the plant-based initiatives, but I would tell you that just having studied a number of these organizations, it'll be a while before certainly it impacts the seafood sector, because of the taste profile, the challenges in replicating what human beings love about seafood. But it's certainly something that I think adds to the diversity of production that we need overall to feed an ever-growing planet. Sir, in the back? Do you need a mic?
Do I need the mic? I'm okay. Thanks, Howard. That was a very clear and compelling talk, and I think it's unfortunate there aren't more people here. You're a victim of the schedule.
Yeah, that's what they tell me.
Yeah. So I work with tropical aquaculture. Regal Springs have worked with them in the past.
Yeah.
And your talk focused very much on salmon side, the structured, large, organized corporate protein producers of aquaculture.
100%.
And so I'm not sure if it's a question or just a discussion, but
Sure.
how is it that you look at the more unstructured, fragmented? I mean, obviously Regal Springs and tilapia is up there with the salmon players, but
Yep.
in terms of the smallholders across Southeast Asia and Latin America even, who can't afford to implement or onboard themselves to the certification schemes,
Yeah.
and are very much unstructured and disorganized. How do you see the evolution of that side of things, especially as it relates to shrimp and other tropical species?
From a sustainability standpoint, in some ways, I think it's the David and Goliath argument, that you could be the David to these Goliaths, and I'll tell you why. Much of what we were discussing on Maui, Grieg, and Leroy, for instance, is driven by a lot of external forces and a lot of public forces. As smaller private organizations, you get the benefit of kind of choosing what really is driving sustainability for your business, whether that's employment in indigenous or rural communities, or driving a fish or seafood product that is more sustainable than even kind of the Atlantic salmon players. And what I would say is that it's always personal and customized to the business and to the investment. Focus on what you can do extraordinarily well, and develop your ESG policies and your discussion around that, versus kind of looking at the myriad of KPIs and sustainability ratings that we went through because I needed to fill 30 minutes, right? So there's I'm sure a handful of things, like 2 or 3 things that companies like yours can actually demonstrate to investors and draw that attraction. Often when I'm looking at opportunities, I don't want a list of 50 KPIs. Honestly, the revenue drivers and the sustainability drivers are always just a handful anyway. The rest of it is to, fill 30 minutes, right? So that's what I would say to looking at that from a private company standpoint, as well as differentiating yourself from some of the things that we see at these larger organizations. Anybody else? Yes.
Thinking of the sustainable compact, salmon farmers, so salmon as a species is roughly 4% of global aquaculture. Do you see other species that are moving on the ESG side of things? And what do you think about seaweed? There's a lot of hype around that. Briefly.
Yeah, yeah. No, great questions. So I think sustainability is hitting all of aquaculture. Atlantic salmon was just easier for me to pick on. A lot of information available, publicly traded. You know, I think that for any producer that's not looking at ESG or sustainability for their businesses across their entire value chain is missing a tremendous opportunity. There's a lot of capital that's flowing into the space, specifically focused on driving these forces forward at these businesses. And I think that, you know, that touches from shrimp to tilapia to tropical species, sea bass and sea bream, on and on. In terms of seaweed, we've been looking at a couple initiatives that, you know, I probably can't talk about at the moment. You know, I like the consumer use of that species. I like the growth profile. There's a lot of elements of seaweed that are very attractive in terms of a growth perspective as well as sustainability perspective.
So it's a sector to count on for ESG investments.
Potentially. I mean, I think it's always business specific, investment specific, but you know, I definitely like that category. Mm-hmm. I think they penalize me if I don't finish the hour, so somebody come up with a question. I'm actually just kidding, so. Good. Oh, I'm sorry. Yeah.
So, you looked more in depth at the kind of environmental metrics
Yes.
of ESG.
Yep.
And there's kind of less on the social and governance. Is that it because that's what you found publicly reported amongst these businesses, or is it from an investment perspective, is there still less interest around those areas of the agenda?
So that's actually a really great question, and I was actually asking myself that as I was putting together this presentation. So a couple of things. Definitely more information generally on the environmental impact of aquaculture. Just, I think, the nature of the industry, right? It's utilizing natural resources like the ocean and various other elements that are just related to the business model. On the social and governance side, what I've found, and speaking as a financier, you know, the Wall Streets of the world, the investment managers of the world haven't, I think, found a product that really brings the returns from the social governance standpoint, more the social standpoint, because governance, obviously, if you have poor governance at your company, well, you're screwed from a whole variety of reasons, right? On the social side, there's not as many, I would say, investment products and focus on those sides because it's hard to correlate what more diversity in terms of female leadership, in terms of gender gap at your companies are and impact your returns versus the environmental elements that have a lot more KPIs. So that's what I've been seeing in the marketplace. With that being said, I've seen a lot of interesting studies that female leadership at corporations tends to outperform male leadership, for instance, which, much to my chagrin, because I'm a male leader. But so there are elements of the movement that are shifting and trying to focus in on the social elements and the governance elements, and trying to understand how that relates to improving financial performance and returns. Yeah, sure. Sir. Regal Springs.
Still 5 minutes left.
Yeah.
But I think as this was alluded in those 2 points, questions, on the social ESG component,
Yeah.
clearly the salmon guys, it's a whole different ballgame because social and governance, in Norway, in Canada, it's pretty different from, other tropical developing countries.
Yeah.
Pretty different standards. So
100%.
and our challenge is really how do we, I think we're doing a lot of good things, but how do we address and measure or have any KPIs on the social side? This social license to operate that everyone is talking about, how do you measure that? How do you demonstrate those efforts that you do, on a day-to-day basis, employing local people in a place where basically there's no other employment opportunities than aquaculture. But how do you really communicate that? On the environmental side, there's a lot of KPIs benchmark, but on the social side, it's more challenging.
So I was only kidding that I wanted hard questions. So there's, it's a really great question, and I think also, as she was pointing out, a very important one just for the overall industry, and certainly for the investment community. And I use that statement just to buy myself time to think through that question. So, the easiest ones are what we were talking about for the Atlantic salmon farmers. What's your gender gap, right? How much do you have in terms of female leadership at your business? Those are the easy ones. The more interesting ones, and I've seen this with some investments in businesses, is, what is your employment ratio and what is, the value of economic activity that you're bringing in to the areas that you produce, right? Because if your, average salary is, $100,000 or whatever it is, versus the average salary of the underlying area that you operate in, then you can demonstrate real value that you're bringing to the community, right? So those are some of the things that I would immediately suggest in terms of looking at, and they're very powerful. We all know that from an aquaculture perspective, you have to engage with the community in which you operate. No matter whether that's land-based farming or coastal or offshore, there is always some indigenous community or some rural community or others that want to understand how you're impacting their community. So those are things that I think are fairly easy to find just in terms of information, and demonstrate very easily to investors, to stakeholders, your employees, to management, that you're making a social impact by operating in that area. And there's even been some businesses that I've seen where when they actually made the study, they're not doing well on the social side, and obviously they said, okay, well, we have to make this an initiative and try to make those changes. But that's what I would suggest there. Yeah. Yeah, sir.
Do you see any role of large digital technology platforms across industries contributing to ESG reporting or sustainability reporting that would perhaps attract more investment into that sector?
Yeah, so that's also a really great question. I think
Maybe something that you've seen in different verticals or categories that could apply to aqua and especially tropical.
Yep, absolutely. So I think transparency and being able to aggregate that data and showcase it and demonstrate or benchmark it against various peers is very, very important for ESG. There's so many things that can be tracked, a lot of things that shouldn't be tracked, some things that need more reporting, and there's a lot of platforms that are focused on aggregating that data and starting to deliver that to investors, but also other stakeholders. I give you, for instance, just in terms of our practice, we're looking at doing a seed investment in a waste management data company. And what they do is they actually look at various manufacturers and they track their waste footprint on what they're sending to the landfill, what they're dumping in various areas of where they operate. And by doing that, you can aggregate that information and see where all that waste is coming from, and be able to deliver that to regulators, the government, to your own staff in order to help to challenge whether or not you have to continue that kind of waste footprint, right? Well, why are we sending landfill over here? We can actually utilize this for recycling in this area of the community, things like that. And I think those parts of the market, like we were talking about for the ESG data providers and certifiers, are going to be big winners in this race. There's a lot of pockets of niche information that needs to be collected and delivered to the community that would be useful for them in terms of identifying ways to be more productive in terms of their recycling policies, as well as reduction of sometimes overall costs. So. Cool. Is that about an hour?
9 minutes.
9 minutes? Okay. Got it. So I have time for maybe one more question. I don't know. Nobody in the back has like raised their hand to tell me to get off the stage. I don't know what that means exactly, but you in the back.
In your slides, you gave really, a great examples on the green bond, which is a debt instrument, right, fixed income. Could you kind of like illuminate us a bit more on the equity side of investment? The equity investors, how are they focusing on the ESG sustainability investment?
Yeah, great question. So she's actually from Peritus Capital, so she's a ringer, guys. Helping me to chew time, just letting you know. This presentation was actually on overall investing. So that $45 trillion that was looking at the Collier Fair report, that's debt equity investors. And I think that there's a tremendous opportunity on the equity side, not only on the debt financing or kind of green bond side. At Easy, for instance, is we're trying to complete a project now for $45 million in equity finance from a major family office in a land-based fish farm. And the focus of that is really to shift more and more production to land-based and diversify from the wild catch as well as the traditional net pen aquaculture. And again, I don't think a threat to production methods that have been established for many decades. What I think is a natural diversity of the various production methods and innovation that is necessary to feed 10 odd billion people by 2050. So equity, debt, the proliferation of investment interests has been substantial across the board. And it hasn't catered to one specific type of investment product. It has hit them all. Cool. Guido.
Yes. I think a kind of sustainability is also a problem for the wild catch is mortality.
Yeah.
And then after fishing to have less mortality, it's very important.
Yeah.
Between the what I can fish with the quota and what's the end result is. So it's only a statement, but I think it's very important. Like in Canada, they have maybe the wild catch between 10 and 20% mortality, when you can have only 5% to give the people the possibility
Yeah.
to keep it in an environment that it is possible.
Yeah, I think it's a really great statement. Across the board for seafood production, whether it's wild catch or aquaculture or otherwise, mortality levels have to be as low as possible and innovations and technologies that help to drive the reduction of that mortality are really important and actually have very attractive returns, because the implications of reducing, say, your 20% mortality to 10% mortality is millions of billions of dollars in terms of your revenues and bottom line, and obviously is a sustainable issue, because the more fish that are dying and that don't actually make it to the plate is a waste of whatever resource that is. So yeah, absolutely. I mean, we have to drive mortalities down across the board, because that is a definite alignment with sustainability. Thanks. Awesome. Thank you guys for all the attention and great questions. Appreciate the time, and I'll be around in case there are quiet questions that you have to ask.
Thank you.
Take care.